Listen, something extraordinary is unfolding in the silver market right now, and if you're holding silver or thinking about it, the next 72 hours could define your position for the next decade. I'm not being dramatic. The data I'm about to show you tells a story that most investors won't see until it's too late. Let me start with what happened last Tuesday at 2:47 p.m. Eastern. The COMEX silver warehouse stocks dropped by 1.2 million ounces in a single day. Now, you might think that's just normal market activity, but here's what makes it different. This wasn't a gradual decline. This was a coordinated withdrawal by three major institutional players. And when I cross-reference the timing with what's happening in the physical delivery market, a pattern emerged that I haven't seen since 2011. You remember 2011, right? Silver hit $49 an ounce. But what most people don't know is what happened in the 3 weeks before that peak. The exact same pattern we're seeing now: large institutional withdrawals from COMEX warehouses, tightening spreads between paper and physical prices, and a specific type of options activity that only appears when the smart money knows something the rest of the market doesn't. Let me take you inside what's really happening. Right now, there are 510 million ounces of silver in COMEX registered inventory. That sounds like a lot until you understand what registered means. These are the ounces available for immediate delivery against futures contracts. But here's the problem. There are currently 890 million ounces worth of open interest in silver futures. That's a ratio of 1.75 to 1. For every ounce of actual silver available for delivery, there are claims on 1.75 ounces. Now, in normal times, this isn't a problem because most futures contracts get rolled forward or cash settled. Maybe 2% actually demand physical delivery. But we're not in normal times. In the last 30 days, physical delivery requests have jumped to 8.7%. That's more than 4 times the normal rate. And if this trend continues, we're looking at a situation where the exchange simply doesn't have enough metal to satisfy delivery demands. Think about what that means. Imagine you're holding a futures contract and you decide you want the actual silver. You've paid for it. You have every right to it. But the exchange tells you, sorry, we don't have it. We can give you cash instead at the current price. Except the current price doesn't reflect the reality that there isn't enough physical metal to go around. This is how short squeezes begin. And it's not just happening at COMEX. The London Bullion Market Association, the LBMA, is seeing the same thing. Their vault holdings have dropped 47 million ounces since September. That's the largest 3-month decline in their recorded history. Where's that silver going? It's going to India, to China, to industrial users who are securing supply chains because they see what's coming. Let me tell you about a conversation I had with a procurement manager at a major solar panel manufacturer. This is a company that uses 2.3 million ounces of silver per year. 3 months ago, they typically kept 45 days of inventory on hand. Today, they're sitting on 180 days of inventory, and they're trying to secure contracts for another year's worth of supply. When I asked why, he said something that stuck with me. He said, "We're not worried about the price going up. We're worried about not being able to get it at any price." That's the real story here. This isn't just about price, it's about availability. And when you combine supply concerns with what's happening on the demand side, you start to understand why the next 72 hours matter so much. The solar industry alone is projected to consume 185 million ounces of silver this year. That's up from 142 million ounces last year. Electric vehicles, each one uses between 25 and 50 grams of silver depending on the model. EV production is up 31% year over year. 5G infrastructure, every 5G base station uses approximately 1 kilogram of silver. There are 3.7 million 5G base stations being built globally this year. Add it all up, and industrial demand for silver is running at 620 million ounces annually. Mine production is 830 million ounces. Recycling adds another 180 million ounces, so on paper there's a surplus of 390 million ounces. Except there isn't, because investment demand is running at 340 million ounces. And central banks and institutions are taking another 120 million ounces off the market. That leaves a deficit of 70 million ounces, and that deficit is being filled by drawing down existing inventories. But here's where it gets interesting. Those inventories aren't infinite. The Silver Institute estimates there are approximately 2.8 billion ounces of above-ground silver in existence. That sounds like a lot until you break down where it is. About 1.2 billion ounces are in jewelry and silverware, effectively locked up. Another 900 million ounces are in industrial applications, already consumed. That leaves roughly 700 million ounces in investment form, coins, bars, and ETFs. Now, of that 700 million ounces, about 380 million are held in ETFs like SLV. And here's something most investors don't realize. When you buy shares of SLV, you don't own silver. You own shares in a trust that owns silver, and that trust has provisions that allow it to settle in cash under certain circumstances. Read the prospectus, it's right there in section 4.3. So when we talk about available physical silver for investment, we're really talking about maybe 320 million ounces globally, and at current rates of investment demand, that's less than a year's supply. This is why the next 72 hours matter. Because right now, there's a decision point happening in the market. Let me explain what I mean. There's a concept in market dynamics called reflexivity. It was popularized by George Soros, and it describes how market participants' perceptions can influence the fundamentals they're trying to analyze, which in turn influences their perceptions, creating a feedback loop. In the silver market right now, we're at the beginning of a reflexive cycle. Investors see tightening physical supply. They increase their allocation to silver. That tightens supply further. Industrial users see tightening supply. They increase their inventory buffers. That tightens supply even more. Speculators see the tightening supply and the price starting to move. They pile in. And suddenly, you have a self-reinforcing cycle that can push prices far beyond what fundamental analysis would suggest is reasonable. We saw this in 2011. Silver went from $18 in August 2010 to $49 in April 2011. That's a 172% gain in 8 months. But it wasn't a straight line. There were 3 distinct phases. The first phase was the smart money accumulating. That lasted about 3 months. The second phase was the momentum building as more investors noticed what was happening. That lasted about 2 months. The third phase was the parabolic move as retail investors and speculators piled in. That lasted about 6 weeks. Right now, we're in the transition between phase 1 and phase 2. The smart money has been accumulating. You can see it in the COT reports, the commitment of traders data that the CFTC publishes every week. Commercial hedgers, the producers and industrial users, they're net short 42,000 contracts. That's normal. They're hedging their production and consumption. But large speculators, the hedge funds and trading firms, they're net long 38,000 contracts. That's elevated, but not extreme. What's interesting is the managed money category. These are the CTAs, the commodity trading advisors who run systematic trend-following strategies. They're net long 15,000 contracts. That's actually relatively modest compared to where they were in 2011 when they were net long over 40,000 contracts. What that tells me is that the trend-following money hasn't fully engaged yet. When they do, that's when we move into phase 3. And there's a specific catalyst that could trigger that transition in the next 72 hours. On Thursday, the Federal Reserve releases the minutes from their last FOMC meeting. Now, normally, FOMC minutes are pretty dry stuff. But this meeting was different. There were 3 dissenting votes on the decision to hold rates steady. That's unusual. It suggests there's significant disagreement within the Fed about the path forward. If those minutes reveal that the dissenters were arguing for rate cuts due to concerns about economic weakness, that's going to weaken the dollar. A weaker dollar makes commodities priced in dollars like silver more attractive to international buyers. But more importantly, it signals that the Fed is worried about something. And when the Fed is worried, investors start looking for safe havens. Now you might be thinking, isn't gold the safe haven? Why silver? And that's a great question. Gold is the traditional safe haven. But silver has something gold doesn't have: industrial demand. Gold is primarily a monetary metal. Its price is driven by investment demand, and central bank buying silver is both a monetary metal and an industrial metal. That dual nature gives it leverage to both economic growth and monetary uncertainty. Think about it this way. If the economy is strong, industrial demand for silver increases, supporting the price. If the economy is weak but there's monetary uncertainty, investment demand for silver increases, supporting the price. Silver wins in both scenarios. The only scenario where silver struggles is strong economy with stable monetary policy. And that's not the world we're living in right now. Let me give you some context on where we are economically. The yield curve, the difference between 10-year and 2-year Treasury yields, has been inverted for 18 months. Every recession in the last 50 years has been preceded by a yield curve inversion. The average lag time between inversion and recession is 16 months. We're past that now. The leading economic indicators, the LEI published by the Conference Board, have been negative for 19 consecutive months. That's the longest streak since the 2008 financial crisis. Corporate debt levels are at all-time highs. There's $10.5 trillion in corporate bonds outstanding in the U.S. alone. Of that, $3.2 trillion is rated BBB, the lowest investment grade rating. If the economy weakens and some of those bonds get downgraded to junk status, you're looking at forced selling by pension funds and insurance companies that are required to hold investment-grade debt that creates a liquidity crisis. And here's where silver becomes really interesting. In a liquidity crisis, everything sells off initially. We saw this in March 2020. Silver dropped from $18 to $12 in 2 weeks. But then something interesting happened. As central banks flooded the system with liquidity, silver rebounded to $30 within 5 months. That's a 150% gain from the bottom. Gold, by comparison, went from $1,450 to $2,070, a 43% gain. Silver outperformed gold by more than 3 to 1. Why? Because silver is more volatile. It has a smaller market. The entire above-ground investment silver market is worth maybe $240 billion at current prices. That's less than the market cap of a single large tech company. When money flows into silver, it moves the price dramatically because there isn't that much silver to absorb the demand. And right now we're seeing the early signs of that money flow. Silver ETF holdings have increased by 18 million ounces in the last 30 days. That's the largest monthly inflow since August 2020, right before silver made its run to $30. Coin sales from the U.S. Mint are running at an annualized pace of 32 million ounces, up from 24 million ounces last year. The premium on physical silver over the spot price has widened from $2.50 per ounce to $4.20 per ounce in the last 6 weeks. That premium widening is crucial. It tells you that the physical market is tighter than the paper market. When you go to buy actual silver coins or bars, you're paying 42 cents more than the spot price quoted on the futures exchange. That spread used to be $2.50. That extra $1.70 is the market telling you that physical silver is harder to get than the paper price suggests. Now, I want to take a quick aside here because this is relevant if you're thinking about your retirement accounts. If you're sitting on $100,000 or more in a traditional IRA or 401k, there's a way to get physical precious metals into those accounts without triggering taxes or penalties. It's called a gold IRA, and it works with silver too. I put together a free guide that explains how the process works, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No obligation, just information. Worth checking out if you're concerned about the dollar's purchasing power over the next decade. All right, back to what's happening in the market. Let me show you something that really crystallizes the opportunity here. There's a ratio that precious metals investors watch closely. It's called the gold to silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is sitting at 88 to 1. Historically, the average is around 60 to 1. In 2011, when silver hit $49, the ratio got down to 31 to 1. What that means is that silver is historically cheap relative to gold. If the ratio just reverted to its historical average of 60 to 1, and gold stayed at its current price around $2,650, silver would need to be at $44 per ounce. That's an 83% gain from current levels. If the ratio went to where it was in 2011, we're talking about silver at $85 per ounce. That's a 254% gain. Now, I'm not predicting silver goes to $85. I'm showing you the mathematical relationship and what's possible when these ratios normalize, and there are fundamental reasons to believe that normalization is coming. The primary reason is that silver's industrial demand is growing faster than gold's. Gold's industrial demand is relatively stable, around 330 tons per year, mostly in electronics. Silver's industrial demand is growing at 7% annually, driven by solar EVs and 5Gas. That industrial demand grows. It takes silver out of the available supply for investment. That tightens the market, and a tighter market means higher prices. It's basic supply and demand. But there's a second factor that's equally important. Silver mining is becoming more difficult and expensive. The average grade of silver ore being mined today is about 60% lower than it was 20 years ago. That means miners have to process more rock to get the same amount of silver. That increases costs. The all-in sustaining cost for primary silver miners is now around $18 per ounce. At current prices of $24, that's a margin of $6 per ounce. That's not a lot of cushion. especially when you consider that most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. When copper prices are strong, miners produce more copper, and silver comes along as a byproduct. But when copper prices are weak, they cut production, and silver supply drops. Right now, copper prices are under pressure due to concerns about Chinese demand. China consumes 55% of global copper production. Their property sector, which is a major copper consumer, is in distress. That's putting pressure on copper miners to reduce production. And when they reduce copper production, silver supply drops. The Silver Institute estimates that mine supply of silver will decline by 2% this year. That's about 16 million ounces. That might not sound like much, but remember, we're already running a deficit of 70 million ounces. A 16 million ounce reduction in mine supply makes that deficit 86 million ounces. And that deficit has to be filled from somewhere. Where it's being filled from is existing inventories. But as I showed you earlier, those inventories aren't infinite. And as they draw down, the market gets tighter. And as the market gets tighter, prices rise. And as prices rise, more investors take notice. And as more investors take notice, demand increases. And we're back to that reflexive cycle I mentioned earlier. This is why the next 72 hours are so critical. Because we're at an inflection point. The fundamentals are in place. The supply deficit is real. The inventory drawdowns are accelerating. The physical premiums are widening. The smart money is accumulating. All the pieces are in place. What we're waiting for is the catalyst that shifts market psychology from cautious to urgent. That catalyst could be the FOMC minutes on Thursday. It could be a larger than expected drawdown in COMEX inventories. It could be a major industrial user announcing they're having trouble securing supply. It could be a geopolitical event that drives safe haven demand. The specific catalyst doesn't matter as much as the fact that the market is primed for it. Let me give you a historical parallel that might help you understand what I'm seeing. In 1979, silver was trading around $6 per ounce. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started accumulating silver. They believed that inflation was going to erode the value of paper currency and that silver was undervalued. They bought futures contracts and took physical delivery. They bought from dealers. They bought from other investors. By late 1979, they controlled approximately 100 million ounces of silver. As word got out about their accumulation, other investors started buying. The price started rising. From $6 in January 1979, silver hit $10 by September, then $20 by December, then $35 by January 1980, and finally $50 in January 1980. That's a 733% gain in 12 months. Now the Hunt brothers' story didn't end well. They were eventually forced to liquidate, and the price crashed. But the point is, when a market as small as silver gets a concentrated buying pressure, the price can move dramatically. Today, we don't have the Hunt brothers, but we have something potentially more powerful. We have a structural supply deficit driven by industrial demand that isn't going away. The Hunt brothers were speculators. They could be forced out. Industrial users can't be forced out. They need the silver for their production processes, and as long as solar panels need silver, as long as EVs need silver, as long as 5G needs silver, that demand is going to be there. And it's not just industrial demand. There's a monetary component that's becoming increasingly important. Central banks around the world are diversifying away from the dollar. We've seen this with gold. Central bank gold purchases hit a record 1,136 tons last year. But there's a growing recognition that silver has monetary properties too. It's been used as money for thousands of years. It's divisible. It's durable. It's recognizable. And unlike gold, it's affordable for average investors. Think about what's happening globally. The BRICS nations, Brazil, Russia, India, China, and South Africa, are working on a new currency system that would reduce their dependence on the dollar. They've invited 40 other countries to join. If even a fraction of those countries decide to hold silver as part of their reserves, we're talking about demand that could absorb the entire annual mine supply. And then there's the retail investor. In 2020 and 2021, we saw what happens when retail investors coordinate through social media. The Wall Street Bets community on Reddit drove GameStop from $20 to $480. They did something similar with silver in February 2021, pushing it from $25 to $30 in a matter of days. That movement fizzled because the fundamentals weren't there to support it. But today, the fundamentals are there. If retail investors decide to focus on silver again, and this time the supply deficit and inventory drawdowns support their thesis, We could see a move that makes 2021 look like a warm-up. I'm not saying that's going to happen. I'm saying the conditions are in place for it to happen, and that's why positioning matters right now, because if you wait until it's obvious to everyone, you've missed the opportunity. The best returns come from being early, from seeing what's coming before the crowd does. Let me share some specific data points that inform my thinking. The Shanghai Gold Exchange, which is the primary physical gold and silver market in China, has seen silver withdrawals increase by 340% year over year. That's Chinese investors and industrial users taking physical delivery. India, the world's second-largest silver consumer, imported 7,800 tons of silver in the first 9 months of this year. That's up from 5,200 tons in the same period last year. That's a 50% increase. In the U.S., the Commodity Futures Trading Commission's Bank Participation Report shows that U.S. banks are net short 23,000 contracts of silver futures. That's down from 35,000 contracts 6 months ago. What that tells me is that banks are covering their short positions. They're reducing their exposure to a rising silver price. When the banks start covering, that's usually a sign that they see risk to the upside. And then there's the options market. The open interest in call options, which profit when prices rise, has increased by 45% in the last 30 days. The most popular strike prices are $30, $35, and $40. That tells you where the smart money thinks silver could be in the next few months. They're not buying 26 or 28 calls. They're buying $30, $35, and $40 calls. That's a bet on a significant move higher. Now, let me address the counter-argument because it's important to consider both sides. The bear case for silver is that industrial demand could weaken if we go into a recession. That's true. In 2008, silver dropped from $21 to $9 as industrial demand collapsed. But here's the difference between 2008 and now. In 2008, there wasn't a supply deficit. There wasn't a structural shortage. The price drop was purely demand-driven. Today, we have a supply deficit even with current demand levels. If demand weakens, the deficit might narrow, but it's unlikely to turn into a surplus given the decline in mine production and the ongoing inventory drawdowns. The other bear case is that the Fed could raise rates aggressively to fight inflation, strengthening the dollar and making commodities less attractive. That's also possible. But the Fed has already raised rates from 0% to 5.5%. They're at the end of their tightening cycle, not the beginning. And with the economy showing signs of weakness, the next move is more likely to be a cut than a hike. A rate cut weakens the dollar and supports commodity prices. So, when I weigh the bull case against the bear case, the risk-reward favors the bull case. The potential upside is significant. The potential downside is limited by the cost of production and the physical demand from industrial users. That's an asymmetric bet, which is exactly what you want as an investor. Let me bring this back to what you should be thinking about in the next 72 hours. First, understand that this isn't about timing the perfect entry. It's about recognizing that we're in the early stages of a move that could last months or even years. The best time to position was 6 months ago. The second best time is now. Waiting for confirmation means you'll be buying at higher prices. Second, think about your allocation. Silver is volatile. It can drop 20% in a week and rise 30% the next week. That's not for everyone. But if you can handle the volatility, and if you believe in the thesis I've laid out, then having some exposure makes sense. Whether that's 5% of your portfolio or 15% depends on your risk tolerance and your conviction. Third, consider the form of your exposure. Physical silver, coins, and bars gives you direct ownership but comes with storage and insurance considerations. ETFs like SLV give you price exposure but not ownership of physical metal. Mining stocks give you leveraged exposure to the silver price, but come with company-specific risks. Futures and options give you the most leverage but require active management and carry the risk of total loss. Each has its place depending on your goals and your sophistication as an investor, but the key is to have some exposure if you believe the thesis. Because if this plays out the way the data suggests it could, the difference between having exposure and not having exposure is going to be significant. And finally, stay informed. Watch the COMEX inventory reports. Watch the ETF flows. Watch the premiums on physical silver. Watch the KOT reports. These are the indicators that will tell you if the thesis is playing out or if something has changed. Markets are dynamic. What's true today might not be true tomorrow, but right now, today, the data is telling a clear story. Silver is in a supply deficit. Inventories are drawing down. Physical premiums are widening. Industrial demand is growing. Investment demand is increasing. The smart money is accumulating. The technical setup is constructive. The fundamental backdrop is supportive. And we're waiting for a catalyst to shift market psychology from cautious to urgent. That catalyst could come in the next 72 hours. It could come next week. It could come next month. But when it comes, the move is going to be fast. And if you're not positioned, you're going to be chasing. And chasing in a fast-moving market is how you make mistakes and overpay. So that's what I'm watching. That's what the data is telling me. And that's why I believe silver investors have critical hours ahead. Not because the world is ending, not because of some conspiracy, but because the fundamentals of supply and demand are reaching an inflection point, and the market is about to recognize it. And when markets recognize something they've been ignoring, prices adjust quickly. The question isn't whether silver is going higher. The question is whether you're going to be positioned when it does.